All right, so good morning, everyone. My name is Lauren Thompson. I'm the Technical Assistance Advisor at JARI. Today we have Tiffany Wetzel-Sturts and Emma Walker from Barnes Sally with us. They'll be presenting some pretty valuable information on financial statements and how to read them. And if you have any questions, please jump on during the session. We want this to be as interactive as possible. So if you have any questions or comments throughout, go ahead and just unmute yourself and join us in conversation. And I'll watch the waiting room as people come in. Tiffany and Emma, I'll let them in. And if you have any issues, just call out and I'll try to fix it from our end. So at this time, I'll turn it over to Tiffany and Emma to go ahead and take it away.
All right. Good morning, everyone. Thanks for joining us. Before I share the PowerPoint presentation, I, again, just wanted to introduce ourselves. Again, I'm Tiffany and Emma's joining me from our Somerset office. We did do PowerPoint only because we find with accounting, it's really helpful to show some examples and have some good, slides to share this information with you. So I'm going to go ahead and share that at this time. Hopefully no technical difficulties. Okay. Can I get a real quick thumbs up, Lauren, if that's working? Fantastic, thank you. All right, so just where to start, what are we going to do today? What are we hoping to accomplish? So our objective is really to help, non-accountants or maybe business owners better understand their financial statements. Normally at this time, if we were sitting in person in a room, I would maybe ask for you to raise your hands if you're a business owner, or maybe try to take a poll and see how many of you have actually taken an accounting class. But since we're on Zoom and I know we have our cameras turned off, I just want to say that hopefully no matter what level you're at or where you're at, you'll find something useful out of today's presentation. So again, today's topic is how to read and use basic financial statements. So financial statements, they're critical and crucial for any business, but they can be confusing if you're not an accountant, and I know that. But hopefully after today, you can read some basic financial statements, understand the basic elements of those statements, maybe finally understand that statement of cash flow. This statement is the most misunderstood and maybe underutilized statement, but hopefully after today, it doesn't give you as much trouble and you can find it helpful. Hopefully you can use your financial statements to calculate, basic financial ratios and analyze those statements to make better business decisions. Why are financial statements so important? Why this topic? They offer an overall picture or window into the health of a company. So whether it's your company or a company you're interested in investing in, or maybe the company you work for, you might be an employee. The financial statements can really help you gauge how that business is doing and see the financial overall health of a company. And while I'm trained and other accountants, to read these statements and understand them, we know that you're not. So how can we help you with that? And that's what we're hoping to accomplish today. Why are they so important? Why bother? Why take the time to prepare them? Why take the time today out of your busy schedules to learn about them? It depends on who you are. Kind of back to that, again, if you're the business owner, financial statements are really important to understand, of course, how your business is performing. To know where you're succeeding and maybe where you're struggling. It might not be obvious without a financial statement. And of course, to help you make those business decisions, where are you going? What's your next step? For other users, maybe an outside granting agency, they're going to request financial statements. Potential donors, they're going to use financial statements to decide if they should contribute to your organization. Banks and investors are other really common users of financial statements. And of course, internal bookkeepers, they have to have accountability to the owners and the stakeholders of the company. So they need to make sure they can prepare good financial statements for that accountability. And it also gives them some security in case anything's questioned. our next one here, Emma, I'm going to let you take that.
Okay. So what are financial statements? They are written records that convey the business activities and the financial performance of a company. They show where a business's money came from, where it went, and where it is currently. So why do you as the company need financial statements? Well, they're an essential tool used to gain knowledge about your company's performance and a clear picture of the company's financial position. So when do you need to prepare your financial statements? Well, for small businesses, monthly basic financial statements are usually ideal. You may also be required to prepare a compiled statement at the end of a company's tax year. And some ways you can obtain your financial statements, they can be self-prepared, or you can have an accountant such as us prepare them. Oops, good one. Thank you. All right. So the financial statements consist of data from the general ledger that has been summarized and put into reports, also known as the financial statements. The basic financial statements consist of the balance sheet, the income statement, and the statement of cash flows. The balance sheet gives a snapshot of your assets and liabilities and equity at a specific point in time. The income statement, which is also known as the profit and loss statement, gives you a view of your revenues and expenses for a period of time. And the statement of cash flows allows you to see where your cash is being spent and where it is coming from. All right, so before we go into the details of each of the basic financial statements, it is very important to understand the basic accounting equation. This is assets equals liabilities plus owner's equity. Assets consist of what a company owns. Liabilities consist of what a company owes. And owner's equity consists of what a company would have left over to be distributed to the shareholders if it liquidated all its assets and paid off all of its liabilities. The accounting equation helps to assess whether the business transactions carried out by the company are being accurately reflected in its books and accounts. All right. So the first statement we are going to look at is the balance sheet. The accounting equation is the basic structure of the balance sheet. This statement summarizes the assets and liabilities of the organization as of a specific date. So the first part of the balance sheet consists of assets. Remember, assets consist of what your company owns. They can be broken down into two categories. This is current and non-current. Current assets are items expected to be converted into cash within 1 year. Some examples of these would be cash, accounts receivable, inventory, and prepaids. Non-current assets are expected to be kept by the business for longer than 1 year. And some examples of these would be long-term investments in fixed assets such as property, plant, and equipment. The next section of the balance sheet consists of liabilities. Liabilities consist of what your company owes. Your financial obligations, such as accounts payable, mortgages, loans on equipment, and these can also be broken down into both current and non-current. The last section you will see on the balance sheet is owner's equity. This consists of what remains at the end of the year after all the liabilities are taken against the asset accounts. Owner's equity is often referred to as capital, retained earnings, or net assets. Something to keep in mind also when preparing the balance sheet is that your assets should always equal your liabilities plus equity. And if they don't, you have an error in posting. So I have an example here of the balance sheet, and you can see that total assets of 5,200 equal the total liabilities and owner's equity of 5,200. And that's how it should be all the time.
I'll just, if I can add something to that, the mention of current and non-current, I think, is really helpful, and maybe something that's that's passed over or missed sometimes. People don't consider doing, but I think it's really important to know your current liabilities. What obligations are coming due in the next year? Yes, you might have a 30-year mortgage, but how much do you have to pay within the next 12 months so that you know what your cash flow needs to be to help cover that debt and those current accounts payable. So while this example didn't show, current and non-current, that's always something to consider. All right, the next financial statement is the income statement. Of course, this might sound pretty straightforward. It's the summary of all your income and expenses, and it's for a specific period. So instead of a snapshot, a date and time, it's for a period of time. The purpose of that income statement is to show the financial performance over a period of time, and it really tells the financial story of that business and all of their activities. How good is the company doing? Is it making money? I also like to mention too, it has some other different names. Income statements, very general and obvious, but it can also be called a statement of operations or a profit and loss statement, or even for nonprofits, a statement of activities. So while it might have different names, the end goal is to show the net income of a business. I think it's the most intuitive and maybe the most important financial statement, because it really shows the profitability of a company. And that's the metric that even those that hate numbers, the most accounting allergic business owners should watch closely. You need to know if your business is doing well and if it's profitable. So you can determine if your business is generating a profit, or maybe it's spending more than it earns, it's showing a loss. You can even learn from an income statement how much it's paying to produce its products. Maybe it needs to change some things. And this is where that using your financial statements to make business decisions comes into play. We'll talk about how an income statement is going to be a really useful tool in making business decisions. So the income statement, what does it look like? Really, the bottom line of that statement has to show the company's net income or loss during that time period. Accountants and maybe investors and other business professionals, maybe the company's leaders, the CFO, the CEO, and of course the owners, they have to regularly review their income statements to understand how well their company is doing. Again, is it profitable? Maybe is there cash left over to invest in the business and to expand or grow that business? All right, so a lot of information here. Let's take a closer look at some of the elements of the income statement. This is just a really small example here, but it includes some of the highlights. Let's go in depth in these. The revenue, in its simplest form, might be obvious, but it's the amount of money a business takes in or earns. In this example, it only includes revenue from operation and from the selling or the sale of goods. The next section on this example here is cost of goods sold. So if you're a manufacturing type business or a company that's selling inventory, you would have cost of goods sold on your financial statements and your income statement. This would be the cost of the various parts of what it takes to make whatever a business sells. And again, that's from mostly manufacturing businesses is where we see cost of goods sold. Gross profit then is your total revenue less cost of goods sold. Of course, though, we have other expenses besides what it takes to produce your items or the purchase inventory. You have other expenses, and those expenses could include your fixed expenses there of rent, utilities, maybe insurance. It's also going to include variable costs, maybe as wages. Again, you can see other examples there, cleaning and miscellaneous expenses. The next line typically is called more operating income. In this example, it says net profit, but I would typically. Okay, I think someone was just unmuted there for a second. Gross profit, the operating income, which would typically be the next line item on the income statement, would be your gross profit less operating expenses. Some other income statements, though, and some other common sections on an income statement include EBITDA. I don't know if anyone's ever heard that term, EBITDA, or maybe been asked about it and they weren't quite sure. But EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It's pretty obvious then the next section would include those elements, your interest, taxes, depreciation, and amortization. So if we showed our earnings before them, if we have any interest, taxes, depreciation, or amortization, we now have to show those.
Tiffany?
Yeah.
There's a question in the chat.
Fantastic.
It says, how does this differ with a service biz versus a product biz? Service versus product.
Service versus product, that's a great question. So if you're a service business, you're most likely and will not have cost of goods sold section at all. So many times you'll show your revenue and go straight into your expense section. And I think that's the biggest difference. I wanted to show this example only because to show where the cost of goods sold would be located on the statement if it applied for your business. Okay, great, thank you. There's also usually a section for non-operating revenues and expenses. Some items that are usually listed in this section would be interest, dividends, if you have maybe investments at banks and so forth. Also interest expense on loans. And extraordinary items, this one we don't see too often, but maybe you have a loss from a fire or a natural disaster or from a lawsuit. That would be in a non-operating section. And then something more common, a little more common than that, would be gain from the sale of assets. That's something we see pretty often. And you want to keep that separate from your operations so that you can really make decisions based on your operations, not those one-time rare occasions. Okay. As I probably already mentioned, it's important to note income statements do not all look the same. The formats are going to vary. If you are using an accounting software such as QuickBooks and you look at a profit and loss statement, it's going to look very different from the example shown here. It might group all your revenues together and all your expenses, whether operating or non-operating. It really depends on how your chart of accounts is set up. And I also just wanted to add here too, just in case you joined today to learn more about reading financial statements for companies that are publicly traded. Maybe you're looking to invest and you want to be able to understand those financial statements that are public. For a publicly traded company, they're also going to include earnings per share. It's just the company's profit per outstanding share of stock. And if you're an investor looking to buy stock, that's going to be an important figure for you. A little less common though. All right, the next statement of cash flow, that's Emma.
So this statement is considered one of the more complicated statements, and I know it can be scary for a lot of people, but once it's understood, it's an extremely beneficial statement. It shows how a company is paying for their operations and their future growth. It explains how cash was generated and used throughout the period. So there are three main sections to this statement: operating, investing, and financing. The operating activities section, the primary element of this is net income. It consists of basic operating activities of a company, such as cash received from customers, cash paid to vendors, interest income, gains and losses from the sale of assets such as equipment. And this section removes certain non-cash transactions from the net income as it was reported on the income statement to show that the cash generated, from true operations. The investing section reflects other payments for the acquisition of capital goods or investments made during the time period. So this shows what a company is investing in for their future by purchasing equipment and making actual investments. The financing activities, these include issuing or repurchasing stock and debt during the reporting period. The section also shows how the company is financing their current activities with debt or equity transactions with the owners. All right, so what is the difference between cash flow and profit? Well, cash flow and profit are two different measures for financial purposes, both of which are important for running a successful business. The key difference between cash flow and profit is that while cash flow indicates the net flow of cash into and out of your business, profit indicates the amount of money left over after all expenses have been paid. And this includes non-cash expenses such as depreciation. All right, so here's an example of a cash flow statement. You can see the operating activity section is first, and the different items it consists of different operating activities. Then you have the investing section and the financing section. And something important here to note is that your ending cash balance here should always tie to your cash line item on the balance sheet.
And I'd like to just add to that. I think what Emma just said is really key and important to read the financial statements. All of these financial statements we're discussing are linked in some way. A piece of information will flow from one to another. As Emma said, the ending cash balance from your statement of cash flow will link to your balance sheet. But you'll also notice at the top of this statement, our first line item is net income. Well, that came over from our income statement. So again, they're all linked. The information flows from all of from each other, from the different statements. Ooh, yep, that's me. All right, sorry. The next statement, it's a little less common and might not apply to many of you, but just in case, I wanted to cover it today. It is the statement of retained earnings. It would be relevant for a for-profit corporation that has equity transactions. The statement shows these transactions, which include maybe distributions to shareholders or contributions from stockholders. So if a shareholder puts money into a business, that's one example that would be reported on this statement. It also reports the ending retained earnings balance. And I believe we mentioned earlier that retained earnings, it's really important. That's the profit that the company kept. The company has still kept and hasn't distributed to the owners, and that they can invest in the future of that company to grow. And so that retained earnings, if that's a positive number, that's a really great sign of strong financial position for a business. Again, many times if a company is not required to show this financial statement or prepare it, this change in equity or change in retained earnings will sometimes be shown at the bottom of the income statement. So we'll have our net income and we'll still show beginning retained earnings, that net income, and then to calculate our ending retained earnings, which again flows back to the balance sheet. Retained earnings, we're always looking for a positive number there. This here is a really small example of what a statement of retained earnings could look like. Again, with the bottom line being retained earnings at the end of the financial period.
Average online communities generate 4,530% ROI. That sounds like, so I did a bit of research. For every $100 you invest in growing your online community, you'd get an average.
So that is, okay.
Now I get
Sorry about that.
well, so much on building a loyal following. And maybe you can see why it makes software like Pencil a no-brainer for your
I'm just making sure everyone's awake today.
with the #1 marketplace for community-driven entrepreneurs. Today, we're diving into Pencil, an easy-to-use platform that helps you launch, grow, and
Sorry, I don't think, here, let me see here. There.
Okay.
You're
Sorry about
good.
that, guy. We're just making sure everyone's awake, that's all. All right, I think this is the really interesting and important part of today's conversation, analyzing your financial statements, using them. How are they helpful and useful to you, as a business owner or an individual? So there's a couple different ways you can analyze financial statements. The most common way is year-to-year comparison. Many times financial statements, when they're prepared, are comparative statements, meaning that more than 1 year is presented at a time. It's very common to see at least 2 years presented in a financial report. It can be very helpful to look for changes from year to year and look for any changes that seem out of the ordinary. We can talk a little bit about how that can help maybe even identify fraud. You can also compare the current reporting period with previous ones using a percentage analysis. That's a pretty common report that comes from QuickBooks to show the change as a percentage from the prior year. It's going to really help you identify significant variances that you might need to look into. Some things you'll learn from this analysis, maybe have your assets really grown? Maybe your inventory balance is too high. You keep buying all this inventory, but you're not selling it. You're going to notice that if you do a year-to-year comparison. Some other things you could learn is, have you acquired a lot more debt? Are your liabilities growing too fast? Maybe you're not collecting your receivables fast enough and your receivable balance keeps growing year after year. You might need to hire someone to help collect receivables and past due bills. Maybe it's time to invest in equipment or buy a new facility and grow. That's all something you can learn from analyzing these financial statements. Those are just some really common examples. Do you have enough cash to pay your current obligations? We talked about, again, that cash flow statement is showing you the cash you're generating from operating activities. Are you generating enough cash flow from operating activities to cover those current debt obligations? The next way you can analyze financial statements is by analyzing trends. It's pretty similar to a year-to-year comparison, but there's more to it than that. If you're comparing multiple periods or multiple years, you can look back 5, 10 years. You're going to learn a lot more about your business this way. You're going to be able to tell if you're underperforming maybe in a certain time frame. Let me give you one example. I'm sorry, I think I got off topic there, but if you look at a financial statement or an income statement by month, this would be one example. You might see that certain months your revenue is way down. Maybe you have some competition that month, or something's happening in your community. Maybe you need to spend a little bit more money on advertising that month. You're going to be able to identify those, underperforming periods or timeframes by doing this type of analysis. Another really helpful analysis is a budget to actual comparison. Some businesses take the time to create a budget, but they forget to use that budget. So you use that budget by comparing it to your actual results regularly, maybe monthly or quarterly throughout the year. It's going to help you identify if something's off the mark, if something is not where it should be, and you as a business owner can look into that further. Another really helpful one, something I help a lot of clients with, is helping their company compare themselves to others in the industry. If you want to know how your business is comparing to its competitors, you have to look at industry benchmarks. That's something that's not just out there maybe to the general public, but there is a lot of financial data available, and those benchmarks for certain industries that are available to us, certain things that we subscribe to, that can really help business be able to compare themselves to others. By comparing yourself to others within your same industry, you can help identify where you're performing well or where you need to improve. If the industry benchmark is showing a gross profit of 60% and you're only showing a gross profit of 40 or 30%, you know that something isn't quite right specifically to your industry. As I alluded to earlier, analyzing financial statements is a really useful tool and one way that you can identify potential fraud. You're going to notice variances when you compare or when you review your financial statements and analyze them. And you can go to your bookkeeper and inquire about those variances, or look back at your own financial records if you're preparing them and see what happened and make sure that there's no fraud. The last way you can analyze financial statements is by calculating ratios. Use those financial statements to calculate certain ratios, and it's just a really helpful thing, can be very useful. So I'm going to let Emma talk about some really some of the common financial ratios.
Okay, so you might be wondering, why do you need to understand financial ratios? Well, they are another tool used along with your financial statements to assess how well your company is performing. Once the financial statements have been prepared, you can easily grab the information you need from the statements to prepare these ratios. The ratios are used to analyze the health of a company's financial situation and to assess the company performance year to year. Some different types of financial ratios are liquidity, solvency, activity, and profitability. So we're going to start with liquidity ratios. These measure a business's ability to cover its short-term obligations without having to borrow or invest money in the business. The most common liquidity ratios are the current ratio and acid test ratio. Solvency ratios are measures to assess a company's ability to meet its long-term obligations and thereby remain solvent and avoid bankruptcy. Some common ratios for this would be debt ratio and debt equity ratio. The activity ratios, there are many useful gauges of operations that can be calculated from data reported in the financial statements. For example, you can determine the average number of days it takes to collect on customer accounts or the average number of days to pay vendors. One of the most common ratios here would be accounts receivable turnover. Profitability ratios, one of the most common ratios here would be profit margin. And this can be expressed as the gross profit margin or net profit margin. And company can express, it's the gross profit margin or net profit margin by product or by individual unit. The information reported on the income statement will enable you to determine the overall profit margin. All right, so the current ratio is your current assets divided by current liabilities. This is a measure of general liquidity and used to analyze short-term financial position. So when current assets are higher, this is going to imply that the organization has more assets available for use, which reduces their susceptibility to risk. So when preparing this ratio, a higher asset figure is going to equal less risk, and a higher liability figure is going to have more risk.
I just want to mention, sorry,
go ahead.
I just wanted to mention too, for these ratios here that you're talking about, this information is all going to come straight from your balance sheet. And hopefully with having that classified balance sheet showing current and non-current assets and liabilities, these ratios could be calculated very quickly. Sorry.
No, you're fine. All right, so the debt to equity ratio is going to be your total liabilities divided by total equity. So this ratio calculates the amount of assets owed to outside parties versus owned by owners. So here, a higher ratio is going to indicate the company is more often financing its operations rather than self-funding. So a lower ratio is going to be better. Okay, so then the accounts receivable turnover, I mentioned this was one of the activity types. This ratio indicates how efficiently a company is collecting receivables from its clients. A higher ratio is going to indicate that the company's collection practices are efficient and that the customers are paying their debts in a timely manner. So a higher ratio is going to be better here. Profit margin is the equation for this is going to be earnings from operations divided by your total revenue. And As Tiffany was saying earlier, so for the accounts receivable turnover ratio, you're going to find net credit sales. That's going to come from the income statement, where your average accounts receivable will come from balance sheet. And for the profit margin, these items are going to come from the income statement. The profit margin ratio helps an organization identify its operating efficiencies. It is the ultimate measure of profitability, and a higher ratio here is always better.
Okay. So again, we only showed a few examples of ratios. There's probably hundreds out there, but these are really common ones. If you are a business that has inventory, there's inventory turnover, maybe again, related to another example I shared earlier, maybe you're purchasing too much inventory and it's sitting there, and there might not be a need to do that. That inventory turnover ratio is going to be a good way to determine that. But again, feel free, you can do a quick internet search to learn more financial ratios, and that can be really helpful in analyzing your financial statements and learning more about your business. And sometimes comparing those ratios to others in your industry, that's going to be a big eye opener for many business owners. So kind of here at the end, bringing it all together, we talked about those financial statements and elements of them. We touched on why they're so important, but really, how can we use those financial statements to make business decisions? We talked about some examples already, but let's go ahead and dive into that just a little bit more. I know Jari works with a lot of small businesses, so I try to always look at that. And hopefully, maybe there's some small business owners here in attendance today. And one thing that really that small business owners struggle with really can be cash flow. They might have months where cash flow is an issue and their business might not continue because of that. So again, using the statements of cash flow are going to help you know and see where your cash is going. So that's just, again, one more example of why these statements are so important. So you can really understand your financial position and the financial health of your company. You can also learn about, your total debt, ability to repay them. That's really key. If you're borrowing a lot of money at the beginning of your business, you have to be able to repay those debts. Profits and losses for any given period. Again, you don't want to wait until just the end of the year to prepare your financial statements. I like to stress here that, you really want to prepare financial statements regularly, monthly, quarterly at least, so that you can know how you're doing and you're not surprised, maybe at the end of the year or when cash flow really becomes a problem. By preparing financial statements and reviewing them more regularly, you're going to be able to identify these problems sooner. You're going to be able to see where profits are increasing or decreasing compared to prior periods. And, also monitor those expenses. Maybe you need to switch vendors for certain things. So some of these decisions, let me kind of get back to that. So a few more examples, some really big ones I get asked a lot. Does my business have enough cash flow to purchase a new building or a big piece of equipment so they can expand? Well, that statement of cash flow, again, to mention that statement, it's going to tell you if you have enough cash flow to cover maybe new debt to help you finance and purchase those new assets. So that's one really big decision that you can help, or you can get the help from your financial statements. Another one, especially we see a lot, do you need to cut costs? While you have some fixed costs you can't change, your rent, your utilities, those might not be, you can't do much about those, but there are some costs that you can cut. Again, maybe calling your vendors, looking for a new supplier, asking for new quotes. Insurance is another cost that sometimes can be cut. And maybe you don't realize you need to take action and do anything until you prepare your financial statement and see those expenses are a little too high. Another one too, with the current workforce problems we're having, can you afford to give raises so that you can retain your employees? Or maybe you're hiring a new employee and you need to know, can you pay them the $20 they're asking for? You need to look at your overall financial picture, your bottom line, your net income, and your cash flow to make sure you can pay, these higher wages that are currently, being asked for. And then don't forget too, if you're paying higher wages, you're also going to have an increase in payroll taxes. Your share of Social Security and Medicare taxes is going to be an additional expense to you as a business owner. So those things are really important, and you need to, before you just agree to give everyone a raise, you need to make sure you can afford it and so your business can stay open. Another example, if a business maybe has multiple locations, is each location performing as it should be? Is it worth keeping each location open? Maybe you have one that's showing loss after loss and it's bringing down the overall total business. You need to look at that. And then the other one too, if your business is not hitting its targets or its budget, you may not know that until you analyze that, budget to actual. You may need to pivot or even change your overall strategy. Maybe you have too many products you're offering, too many service lines. Maybe you need to focus on just one area that you're performing well in. Those are, just one example. I think I talked earlier too about advertising. If you aren't advertising a certain product and you're looking for that product to grow, maybe it's worth investing in that. So financial statements can help you see all of those things and make those decisions. Also too, just to make sure so those are how business owners are going to use those financial statements to make decisions. But others are going to use your financial statements to make decisions too. The bank is going to look at your financial statements to decide if they should give you a loan, to decide if you're a good candidate to receive that loan and if you're going to be able to pay it back. Or maybe you're looking for a business partner or for someone to invest in your business. They're going to ask for a copy of those financial statements, and it's going to give them an idea of the financial picture and the financial health of your business and if it's a good investment for them. So yes, of course, you're going to use these financial statements, but remember, outside users will use them too. One last thing here, we're finishing up just a little bit early, but I think that's going to save time for some questions. Financial statements, can also help a business determine their break-even point. This really does apply just for manufacturing business, but if you're producing products, where's that point of production where you're finally producing and selling enough to cover your production cost? That you can't just pick a magic number and produce 1,000 widgets without analyzing this and knowing where this break even is for your business. So, again, manufacturing might not be very common among small business owners, but it is an important measure if you are in manufacturing. I have a couple of very quick slides just to kind of wrap up at the end here. There are different ways that financial statements can be prepared and presented. So if you're preparing your financial statements in accordance with GAAP, or we call generally accepted accounting principles, most of the time that's what I'm preparing for my clients. That's the full accrual method. So accrual method is where you're best matching your revenue with your expenses. Your revenues are recognized when earned, and your expenses are recognized when they're incurred. It's not so much based on cash. It gives a really clear picture of that entity's financial growth. And you don't have the timing issues that you sometimes have with cash methods. And then some banks and granting agencies require GAAP financial statements. So if you're preparing your monthly financial statements in QuickBooks, perhaps on a cash basis, you might need to consult with the CPA about getting those converted to GAAP basis. So cash basis is more common. It's much easier to prepare your financial statements on this basis. You recognize revenue when you collect the cash, you recognize expenses when you pay the cash out. But revenues and expenses might not match in the right period. Maybe you incur this expense in year one, but you don't sell it until year two. That's one example of not matching. And then of course there's a modified mixture of the two. It's a combination of cash and accrual. It's not generally accepted. However, many banks do accept it. It is also helpful, and it's a happy medium. So an example would be here, maybe you want to do cash basis. It's really nice to just record that activity as cash comes in and cash goes out. But maybe you also want to track maybe some accounts payable at year end. You want to know at year end what you owe. That would be a modification. So it'd be a modified cash statement. Or same with receivables. Or maybe you want to track your fixed assets. Again, these would all be modifications to the cash basis without having to do a full accrual statement. I think I mention this every time I'm asked to talk to groups like this, just because it is so important. I can't stress it enough about how important it is to have accurate financial data. If you're a new business starting out or someone is well established, just making sure that you have your financial records in good order. So important. Make sure you're using some type of an accounting software. Again, QuickBooks being very common. There's tons out there. Make sure you get training on that product. Make sure you're using it to its fullest capabilities, and the setup is really important too. Performing monthly reconciliation. So maybe you're not at the point where you're doing monthly financial statements yet. Make sure you're reconciling your accounts at least monthly. Make sure you're reconciling that bank account to make sure you don't have a lot of outstanding checks and think that you have all this cash. And it's really important to do that. Make sure you keep your accounting records up to date. We just got through tax season and we talked to many business owners at that time, and they kind of throw all their receipts and things in a shoebox. They have no idea what things look like until the end of the year when they ask us to put it all together. So their accounting records are not up to date. They have no idea how their business is doing. I don't recommend that in any way. You need to have good financial up-to-date records to be able to make good business decisions and to know how you're doing. Another key takeaway, again, for new business owners, I always like to mention this: separate business and personal transactions. That's so important. Try to have separate accounts always, so that your personal transactions and personal expenses are not being paid out of your business accounts. Rather, take a draw, write yourself a check and then deposit it into your personal bank account and pay your expenses from your personal account, not business. It's going to help to keep things separate. And of course, if this is overwhelming for you and you are not a numbers person, you have the idea and you want to work hard, but you need help with the numbers and the financials, hire an accountant. Hire an internal bookkeeper or outsource that service to an accounting firm. An accounting firm is going to be able to help you with that day-to-day accounting, but also to help you prepare those financial statements if they're needed. All right, well, that took us pretty close to the end of the hour, but I'll just open it up this time if anyone has any questions.
Yeah, if anybody has questions, now's your chance to either unmute yourself and ask, or you can type them in the chat and I can read them out too.
I have a question for you, Tiffany. You talked about it at the very end, reconciliation. What does that mean and how do people do it?
Yes, so I'm going to start with the most common and very important reconciliation is your cash reconciliation, your bank reconciliation. So what we're talking about there is reconciling your accounting records. So again, you're using QuickBooks as an example, the balance of the cash that you have in your QuickBooks account with an outside source, such as that bank statement. There is an actual feature in QuickBooks and all accounting softwares to reconcile your bank account. So that's most common, most people know about that. But I also want to mention that you should also be reconciling some other accounts too. Accounts receivable, accounts payable, those accounts can also be reconciled with what we call a subsidiary ledger, which is just another listing of what makes up those accounts. And sometimes they get out of whack or they get out of balance. Your accounts receivable ledger, the ending balance there, so your ledger shows each individual that owes you money. You want to make sure the total of that ledger matches your total accounts receivable balance on your balance sheet. And we do see where in a reconciliation, you find that those two numbers don't match. And you wouldn't know that maybe until you do reconciliation. So bank reconciliation, most important, but all balance sheet accounts can be reconciled in some way or another. Yeah.
Anybody else have any other questions?
All right.
I don't think so.
I don't think so.
Well, thank you all for joining us today, and thanks to Tiffany and Emma for providing the information. Tiffany or Emma, if you could, would you be able to email me the slides if anybody asks for them so I can send them
Absolutely.
out? And then if somebody has questions later, you think of questions later on, feel free to email myself, or you can reach out to Tiffany and Emma and they can answer those questions for you. And then upcoming in June, I feel like is like a month of marketing sessions. So we have a session June 9th, it's on social media marketing, and then a session June 28th that's on video in marketing. We haven't sent out the flyer registrations forms yet, but the first one for social media will be coming out probably later this week, but we will also have them posted on our website. So if you're interested, feel free to check them out, and we'll also send them out in our newsletter over the next couple weeks. So that being said, thanks guys for getting on today, and we'll see you next time.
Bye. Have a great day.
Bye.